Hello, this is Damien, Principal and Lead Analyst at Sagacity. Wanted to give an example of one of the services that we offer our clients and just give a quick overview of how we can simplify maybe a negotiation or a quick decision that you need to make between two investments. So let's get into it. Right now, when you're looking at my screen, you see two tables, nothing too complicated. At the top, we have project name, initial investment, years 1 through 5, net return, present value. Where we want to focus our attention is on the table at the bottom, where we see item, project A and project B. And so what we're going to do is we're going to go through this process and show you how we'll take your inputs to come up with quick decisions that you can be confident in. So as a business owner or as an investor, you're often faced with alternative projects, investments that you need to evaluate. Which one do we want to do? We've got a sum of capital. Where do we want to invest our capital? We want to be able to make those decisions confidently and quickly. A tool like this is built for you to make those decisions. So let's give ourselves some inputs. So let's say we have two investments. Let's say both of these investments require the same initial investment of $150,000. And let's say both of these projects are 5-year projects. And both of these projects, they are associated with $50,000 worth of positive cash flows in each year of the project. So we get $50,000 each year as a result of our initial investment. That's the return on our investment. So let's stop here. What are we seeing? So we got that initial investment, project years, and cash flow, the same for both projects. We look at the top, we see that same activity. Now let's look at the net return column. For net return, we see $100,000. What is that? That's simply stating that over that 5-year term of the project, for the cash flows that we're going to receive, we have $50,000 for each year, $250,000. That minus our initial investment. So our return on our investment is $100,000 at the end of 5 years. Okay, is that good? Are you happy with that? I mean, I know for some people that's probably the extent of the analysis. But as a financial professional, I have to give you more because there's more involved in these decisions, in this decision-making process. And that's what we're about to get into. So before we go to the next step of our risk level, we want to talk about two concepts. The first concept being time value of money. Simply stated, $1 tomorrow is worth less to me than $1 today. The further out in the future I receive $1, the less that dollar is worth to me today. Also, risk and reward. When we're evaluating projects and investments, we want to assess that risk. And if that project has a higher risk, we require more of a return on our investment. Now, let me state this right now. This investment decision that we're looking at is a purely equity deal. There's no debt involved in this. Now, we can do that, but we just wanted to give a simple example. So, now that we have those two concepts down, time value of money and risk assessment, risk-adjusted funds, we have already incorporated those two concepts in our risk level. So now we're going to set a risk level for each one of these projects. Both of them are medium. So for this particular tool, if we provide you this as a client, you're saying that both of these projects say accept. I can only accept one. What does this mean? It means that you can choose either or. It does not matter. These are the same financial outcome for either one of these projects. But typically there's some difference, and that's what we want to provide our clients, the opportunity to see which project or investment is more attractive. But I want to be able to give you that decision as quickly as possible. So let's vary these inputs a little bit. Up until this point, everything has been the same for both projects. But now for project B, we're going to say, well, that project, we're only going to receive cash flows for 3 years after that. Wow, okay. So now that tells us that project A is more attractive as an investment. Let's change this up a little bit more, though. Let's say that instead of $50,000 per year for project B, now we're seeing $80,000 in positive cash flows for that project period. So now we're saying that project B is the project that we want to select. Now let's get into the background of this. Now, first of all, that easy one-step answer that you see there, accept and reject, that's an example of the quick and easy decision-making we provide our clients. But we want to take this time to go behind the scenes really quick, just in a simple example, so you can understand the things that are incorporated in that decision. So let's look at the next line where it says total net cash flow. Essentially what we're saying, once again, just to go over, At the end of Project A, which is a 5-year project, the total amount of those cash flows is $100,000. Total amount that we've received over the 5 years minus our initial investment. For Project B, same thing, but that's over a 3-year period. The $80,000 for 3 years, $240,000, minus the $150,000 initial investment, which we received a return of $90,000. Now, some people may look at this and say, well, why are we accepting Project B when Project A is giving us a higher return on our funds? Well, once again, we want to make all of our investment decisions based upon discounted cash flows. We want to discount all of those future cash flows back to today. We want to see how much is that money in the future worth to us today, right now, present value. So before we get to the discounted cash flows, let's just look at this next line where it says payback period. So this is payback period in years. A lot of people are concerned. You want to know, when are you getting the money that you put out for this investment back? When will you break even? Without discounting our cash flows, for Project A, we're going to break even in year 3. We put out $150,000, got $50,000 for year 1, year 2, year 3, that's $150,000, break even. Project B says 1.9 years. So we received our initial investment back quicker, less than 2 years. But those are not the calculations that we want to make our decisions on. We want to make all of our investment decisions on discounted cash flows because we're incorporating the time value of money and the risk-adjusted cash flows. How risky is this project and how long does it take for us to get our money? The next line, total discounted cash flow. Project A, $17,608. Project B, $32,658. You see, at the conclusion of year 5, we have $100,000. That's more than $90,000 for Project B. So how is it the value of that money in the future is less than the value for Project B of that money in the future? And that's where discounting cash flows come into place. We're getting that money sooner, meaning that money is more valuable to us. That's essentially the variance in this particular decision. Now let's look at this last line, discounted payback period. This is strange, right? Even though the payback period was 3, it's 4.3 years when we're looking at discounted cash flow. It's only 2.4 years when we're looking at Project B. So once again, we're receiving less actual cash from that project in Project B, but that cash is more valuable to us today at the present value. Essentially, what we're saying is the $100,000 at the conclusion of year 5 for Project A is worth $17,608 to us, and that $90,000 at the conclusion of year 3 is worth $32,658 to us today. Which one do you want? Do you want $17,608 or $32,658 today? Which one are you going to choose? And that's how we can simplify your decision-making process, making your investments for your company and even for your private investments. Going to be doing more of these videos in the future, explaining more of the services that we provide at Sagacity. Reach us at sagacityfpa.com and have a good day. See you next time.